Hello, this video is going to address uncollectible accounts and the allowance for uncollectible accounts that's related to recording bad debt expense. Okay? When, when you offer credit sales, there is always going to be some percentage of those are not going to be collected. Okay, it's just a fact of business. If you offer credit to your customers, there will inevitably be a small portion of them that end up not paying. Right? That's totally normal. You don't want to make your credit terms so stringent that you don't have any uncollectible accounts, because that means you're limiting the amount of sales you make because you're not giving credit to creditworthy customers. Okay, so some accounts are not going to be collected. The allowance method for accounting for these uncollectible accounts is required by generally accepted accounting principles. Okay, so the allowance method is required to be used in all except a very few instances. And one of those is if the amount of bad debts that the company has is not material, and not material means it's not a large enough amount to make a difference in the financial statements. Okay, this occurs when the company doesn't have much in the way of credit sales, and therefore the amount of write-offs is not going to affect their income statement by enough to make any difference. Okay? By and large, the um, method that is not allowance, which is the direct write-off method, is mainly used for tax purposes, and that's why it's included in this chapter. Most of what we're going to do is going to be based on the allowance method being required. Okay, this method requires companies to estimate the amount of uncollectible accounts that they have and record that amount as bad debt expense in the same year as the sale. Okay, this is the expense recognition principle. We are going to record the expense, the bad debt expense, in the same time period as the revenue was recorded. That's why we have to do the estimate, because otherwise it may be a different time period by the time that we know that an account is not going to be collected and we write it off. So the financial statements would be out of sync if we recorded the revenue in one period and the expense for that in the next period. So that's the reason why the allowance method is required. Okay, the allowance method reduces assets in the year of the sale. Okay, it reduces accounts receivable. It increases the expense, the bad debt expense. So it affects both the balance sheet and the income statement. All right. When we initially establish an allowance for uncollectible accounts, say we're a brand new company, okay, we have total amount of accounts receivable, okay, and then we have to determine how much of that do we think we're not going to collect. Okay, one method of estimating that is based on the amount of accounts receivable. It's called the balance sheet method because you are using the amount from the balance sheet to estimate how much of that total you will not be able to collect. Okay, example here, company is owed 20 million, blah, 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 blah. They determine that 30% will not be collected. Now that's pretty high, but it makes for an easy example here. So 30% of the 20 million is 6 million. So we record that amount as bad debt expense. Expense goes up with a debit, and the allowance for uncollectible accounts is a credit balance account, so it goes up with a credit. The allowance for uncollectible accounts is a contra asset account. Okay, so similar to accumulated depreciation, which we've already seen, the allowance for uncollectible accounts is attached to accounts receivable. We have the accounts receivable amount and then the uncollected amount as a negative, and the two of them together, when we net them, is net receivables. Okay, here is the balance sheet. Look at that. Okay, we had 50 million in credit sales in 2021. We had 20 million of it not collected at the end of the year. We estimated 6 million will not be collected, or 14 million will be collected. In the balance sheet, then, we have accounts receivable of 20 million, the amount we had at the end of the year, less the allowance, which is a negative number, and then that gives us net accounts receivable. Okay? Income statement. Revenue was 50 million. Okay? Bad debt expense, 6 million. Other operating expenses, for purposes of this example, 34 million. Now, other operating expenses are going to include salaries and rent and utilities and insurance and everything else. Okay? Net income. Okay, when we write off an accounts receivable using the allowance method, okay, we're going to take the amount of the write-off. Okay, so say we find out that a customer died. Okay, customer's not going to pay. So we reduce the amount of accounts receivable by that amount. So accounts receivable is an asset. It's a debit balance account. To reduce that, we credit accounts receivable. And then instead of recording the bad debt expense, because we've already done that through our estimated amount, we will reduce the allowance account. Okay, so what this does is it puts the expense in the same time period as the revenue, even though we're writing off the account sometime later. When we write off the account later, it has no effect on the financial statements at the time of the write-off. Okay, because it reduces accounts receivable and the allowance by the same amount, which are netted together anyway, and our net receivables is going to stay the same. Okay, so no difference in the financial statements when we write off a receivable. Okay, and again, a common mistake, students often want to record bad debt expense when they write off an account. That's only done using the direct write-off method, which again is not GAAP, but is done in the direct write-off method. That's only used in a couple of circumstances that I detailed earlier. Thank you.